Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in there. Let's take a look, see what people are sharing, and I'll share my opinions as we go through it. If you want to follow me at Finance, if you want to join our community, finding-value.com, I dive deeper into the sectors, looking for potential investment opportunities out there. We still have a coupon code Mayday if you want a discount when signing up. It's only 50% off the first month, and you get a larger discount when switching to a yearly membership or signing up for a yearly membership. So Julian, he says, Nvidia continues to follow the pattern of a classic bubble. Having declined over 35% from the highs, see my post from the 30th of July, the move back above 106.50 suggests we are starting the bull trap rally. Typically, when that fails, the trap is sprung and the top is in for Nvidia. So what he's got here is that big stock market bubble, stealth accumulation in 2019 is what he has. Discovery, bear trap, consolidation, the parabolic move, and then he thinks that a bull trap is going to form here or a potential double top, and then a selling pressure move bust after that. That also coincides with the yield curve. The yield curve going up, inverting and uninverting is where these bull traps start to set up here. This is where you want to exit the market in some of these companies that are in bubbles like that. HFI Research says why the Saudis hate Biden in one chart. He's got Saudi Arabia crude oil production way down here at 9 million barrels per day for 2024. I don't know if that has anything to do with Biden. I have no idea why they are necessarily doing that. But Iran crude oil production is way up compared to previous years. So that's what's offsetting Saudi Arabia producing a lot lower and Iran producing a lot more. Patrick Karam says Dow Jones Industrial Average priced in gold. This is one of my favorite charts to look at. This ratio here. It says only the fourth time this has happened in over 100 years. It's only the third time since gold was unpegged back in 1971. US stocks are very close to properly imploding priced in gold. And when they implode, so to speak, or when this originally goes lower, is during a slowdown. It's when the yield curve inverts and then uninverts for most of these. In 1969-70, there was a slowdown recession, and then it extended it all the way down into 1980. So the slowdown is what basically caused the movement. We had a slowdown here too in 2001. This broke out in 2002. So we had the slowdown in the markets kick off this commodity bull market that we are talking about here. And I'll just move this over. So we had one, two, three, and then we're going to start the fourth gold bull era. These gold bull eras signify that we are entering a commodity bull market. It's where hard assets outperform financial assets. You can see also the momentum at the bottom here is crossing below the zero line. So this thing's about to get heated up. And what I would do is I would position in what's going to benefit from this movement. Hard assets are going to come here and outperform. They are going to outperform massively. And this is going to be just like every other commodity bull market. Or at least I entered very early here. I entered very early. I've been waiting for this thing to roll over, and I'm already up on pretty big gains already. I can't imagine what this is going to be like when this actually gets moving. The gains will be tremendous. The gains in hard assets are going to be like the gains in technology stocks. So that's kind of what I think is coming. Big moves for hard assets, and I think we'll see technology and some of these other companies, S&P 500 move sideways in a we'll call it in a big consolidation pattern. The US dollar index is at 5-month low. Once it's obvious the US is in recession and the Fed starts cutting rates, dollar weakness will increase, putting upward pressure on domestic consumer prices and long-term interest rates. The QE rescue package will fuel the fire. Totally agree. It's also going to fuel the fire for hard assets. Hard assets is going to be the spot to be after this recession kind of comes and comes through. Because usually what occurs, you get in an aging kind of business cycle, it rolls over, things slow down. Once it rolls over, they do QE, they lower rates, and then they do some sort of stimulus, and then it goes into another liquidity kind of movement again. So that's kind of the business cycle just going up and down. When it goes down, that's when precious metals outperform. And that's why this chart here, precious metals outperform, and that's where you get the S&P or Dow going down and precious metals going up, which basically brings the ratio lower in favor of gold. Investment wisdom, we've got a couple of quotes here. The elementary mathematics of compound interest is one of the most important models there is on earth, says Charlie Munger. And then Walter says, remember the power of compounding. You don't need to stretch for returns to grow your capital over the course of your life, in his opinion. Casper Uselink says the uranium spot price is still within its 2020 blue uptrend channel and above its daily momentum band. Channel support is at around $77. So the futures price, spot price, is still within the upward channel. Nothing to worry about yet. This could dip out if we do get a recession and everybody starts selling stuff. But I don't think it would negate the uranium bull market. I wouldn't say it's not in a bull market still, even if we go through a recession. And I think that's where people get incredibly confused. How can Andy still be bullish but yet be bearish? It's like, well, that's different time frames. We're in a secular bull market for commodities that started in 2020 was the bottom for a lot of different things. Just because we have a large pullback doesn't mean it's still not in a bull market. It means that we are in a bull market and we're getting a cyclical pullback in a secular bear market. Cyclical means that you can have a 1 or 2 year pullback in a big uptrend of commodities. So higher highs, higher lows. I don't think uranium is going to go back to $10, $14, $15, at the bottom of the market, wherever it bottomed at. I don't think it's going to go down there. It's going to continue on up. And maybe we go down to $50 or something like that. Yield curve is steepening and the markets are panicking. Now it all comes down to when recession. And this is the yield curve, the 10 and the 2, uninverting, coming back to that zero line. And usually when you get above the zero line and you're going on up like these, you get a recession. Yields, the 2-year generally gets lowered quite dramatically during a slowdown. And that's what causes these big acceleration moves, these vertical line moves, because the slowdown is already there. When is it going to occur? I don't know. But it sure seems like we're going to get a slowdown here based off of the yield curve and the way the yield curve is behaving. But this guy has been bearish for a long time, but I mean, rightfully so. Rightfully so. A lot of indicators are screaming that something's going to come. Rick Rule Rhetoric says, when the world comes to the realization that we have underinvested in basic commodities for 30 years, investors will be treated very well. Investors in basic commodities will, definitely. Eric Nettle, there's too much fear-mongering around weak oil demand. Yes, diesel demand in some pockets like China is weak. Yet Chinese jet fuel demand is at all-time highs. 2, U.S. demand is strong enough, may be revised upward by 0.8 million barrels per day. And even the chronically bearish IEA says the U.S. driving season to be most robust since pre-COVID. U.S. shale growth is massively decelerating. OPEC plus supply return subject to market conditions, and I believe will remain proactive, preemptive, and precautionary. The jury is still out. I will believe it when I see it. Global inventories sit at the lowest seasonal levels on record. $80 WTI floor with bouts of volatility remains intact, all while E&Ps are generating record free cash flow and giving it all or almost all back to shareholders. Why all the pessimism? Probably from the yield curve. That would be my guess. I would be a little bit scared because of the yield curve on inverting, because oil hasn't had a great track record of holding up during recessions. So if we do get a recession, I do expect some selling pressure to be felt in the oil markets. I do think that. But when looking at the oil chart, it doesn't look too bad. It looks like we could easily break to the upside still. So we got to wait and see. We got to wait and see how this all plays out. But this is fleet levels peak in August, reaching 17,000 flights per day, or daily aviation active fleet, all up at highs there. Brady says, been posting for years that BRICS will take over the global scene from the West. And this global shift means enormous opportunity. This since commodities are at the core of this very, very big change. This triangle should hold some serious energy. And this is the Shanghai Stock Exchange Composite Index. We've got an 18-year symmetrical triangle, should hold some serious energy when this thing does eventually break. Now, there's two paths he's got here, a break immediately or a false breakout coming where it slingshots it down and then rips it to the upside. What could cause that slowdown? A recession or a slowdown in the markets. And that's where you can get that false breakout. If you get a false breakout, that's going to be a dream of an entry point for a lot of these emerging market areas. Absolute dream. Cross-Border says our latest GLI global liquidity indexes for end of July released today. A taster, world central banks still adding fuel to this liquidity index. So World Central Bank liquidity index heading higher here. Looking pretty good for increased liquidity. And that makes a big difference when liquidity is coming into the system because it finds its way into the stock markets around the world and commodities. Here's platinum to silver. I always have to share this when I see this. He posted this again. It says, if silver is a 14x from here at least, which I think, imagine where platinum would be if this ratio goes back to all-time highs, which I think it will. The chart is now backtesting, looks ready to go now is what he's got. Two massive hammer candlesticks here that dipped 1982 and 2020. And I actually bought in 2020 right in this handle here. I bought a whole bunch of platinum. The reason I bought platinum is because the ratios of platinum to gold, platinum to silver, and platinum to palladium were bottoming in 2020. Platinum was the cheapest it's ever been on a ratio perspective against all of the other metals. And I was like, I gotta get a good chunk in this thing. Yes, I've been in it since April of 2020, and I bought a little bit before that too in 2019. But I'm holding on, and I think this is going to be a huge opportunity. This is going to outperform because I know a lot of people get very anxious. They say, okay, when's this going to go? When's it going to go? When Moon, when Lambo? I get it, guys. It's going to go when this here that I showed you, when this goes down, that's when they rip. So this was the 1970s. This here was the early 2000s. This here is going to be the mid 2020s. And we're going to rip. And that's what's going to cause it. It's going to be a rotation of money away from financial assets toward hard assets. And then whichever one is going up the most, which I think platinum and silver are going to be two really good candidates, people are going to run into it. And platinum usually kicks off the big commodity bull market. So coming from a level of this cheap, I think platinum's an incredible opportunity to buy an undervalued asset out of the system. I think it's probably the best, one of the best assets. Here's James, and his quote says, save more money than you think you need. Life is unexpected, and your future tastes will likely be more expensive. Not worrying about money tomorrow is worth more than whatever you could buy today. I like that quote by James Clear. Here's another one from Grady. So from this chart, we can see that stock market is a function of the currency supply. Fighting inflation as such has never been a priority. The M2 and the SPX are starting to go parabolic. Gold always catches up with M2 and the consumer price index. And it all started when Nixon disconnected USD, the dollar, from gold. Here's the chart here. You can see the CPI just ripping higher. And then you've got gold, M2 money supply, and the SPX, and they're all following that M2 money supply and consumer price index. They're all the same thing. And this is where Nixon closed the gold window in 1971. So it started this whole mess. And the Federal Reserve. The Federal Reserve in 1913. That also started the mess because that's where taxes came about. Federal income tax started in 1913 when the Federal Reserve was started. And that was like step number one. Eisenhower screwed that. And then the second one was Nixon closing the gold window. But that was kind of just a reaction to all of the debt that we've got and us cheating the system. Just cheating the system. I always have to talk about this, guys. It says the mother of all legit looking probable cup and handles. Very large patterns take a long time to build out, but once they get moving, the move then lasts for a very long time. History has built this beautiful silver 45-year cup and handle pattern. We've broken out, guys. We've broken out. Like, I don't understand. Some people are like, maybe I'll buy something else. Like, well, get some silver. Like, this is ridiculous. This is such a great opportunity, and you don't get these opportunities hardly ever in your life. So someone who's born 1970s, 60s, and 70s onward, I mean, they didn't participate when they were in their teens in this 1970s bull market, and now they're 40, 50 something years old. And this is it. This is what you got. You get the one bull market here and one bull market here. That's where we're basically in. What he says is, first it had a picture-perfect quintuple support backtest to red handle arc, black line, gray line, blue line, plus fib, 61.8%. That sure is stylish, is what he says. Then it formed a huge bullish blue expanding falling wedge as a backtest pattern. And now it is in wave 3, moving up the right side of the handle here. Looking fantastic, guys. Go silver. Here's Tavi. 2-year yields have likely peaked for this cycle, and the recent downward trend is probably going to accelerate to the downside as the Fed panics to reverse its policy stance. It's important to keep in mind that historically, falling short-term yields tend to be very positive for gold, which appears to be entering another phase of rising prices after recent consolidation. You don't want to get in the way of this train. Well, I'm going to get in the way of it on the upside. Yeah, whenever we get these falling 2-year yields, that's when we see slowdowns in the market, which are shaded here. We've had big up moves in gold every time. So I don't see why this time would be different. We're going to get a big up move when the 2-year yield drops and there's a slowdown in the market. Gold is the safe haven asset, and this is what is the reasoning behind it. It's when the 2-year yield falls. Whenever that 2-year yield falls, there's generally a slowdown in the market. Gold goes up. Here's another one, gold to NASDAQ ratio. So gold prices closed at record levels today. But what's even more significant, the gold to NASDAQ ratio is currently on the brink of breaking out from a historical resistance. Here is a reminder that the ratio surged 13x from the peak of the tech bubble in 2000 to 2011. History doesn't repeat itself, but it often rhymes. Additionally, one of the most consistently successful investment strategies, following over 70% of the Treasury curve inversions since 1970, was to go long the gold to S&P 500 ratio for the subsequent 24 months, regardless of whether the period was inflationary or deflationary. And this is the gold to NASDAQ ratio, which looks like it's bottoming out. This here is the recovery phase of real estate. This is where we could have entered an expansion phase, is right down here. And we just haven't broken out on a lot of these ratio charts yet for complete and utter bottoms. So gold's going to outperform. We're going to get a break here at any second. where it starts to outperform the NASDAQ. And that's also, if you look, like if I were to sum this up, guys, and go back up, we've got all these patterns that are good for emerging markets, which is non-US dollar denominated assets. We've got gold that looks really good. We've got the yield curve coming up when gold goes up. We've got gold starting to outperform the Dow Jones, which is breaking its upward trend line to the downside. We have a potential bull trap top being formed in Nvidia, which is the tech sector, and gold's going to outperform if this goes down. These are all interconnected together, in my opinion. Everything here is interconnected. So it's the technology stocks rolling over, the yield curve inverted and uninverting or steepening, the 2-year yield dropping. They're all the same thing. It's all interconnected. And all this data is pointing to a slowdown in the market, gold going up, financial assets going down, and then entering a commodity bull market. What starts this all off is generally a slowdown, and that slowdown kicks off lower rates, which kicks off lower dollar. And the commodities are priced in dollars. And when you go down in the dollar, commodity prices go up in dollars. So it's the denominator that's doing all the work here, not necessarily the numerator, which is the commodity itself. The commodities will put pressure because there are supply problems, but the denominator is a big portion of this. But that's what I've got for today, guys. Give me a thumb up for the content, subscribe to the channel. We'll catch you guys later. This is Finding Value.